The market's at a crossroads. We've got high fear, but capital isn't just fleeing, it's rotating. So here is our framework for navigating the next 1 to 2 weeks. Let's get right into it.
All right, first thing you need to see. The Fear and Greed Index is sitting at 18. That's extreme fear. The driver? A pretty rough private jobs report showing the highest October job cuts in 20 years. So you know recession talk is back on the table. And that's putting real pressure on equities.
Look, last week's Fed rate cut was a complete sell-the-news event. It was totally priced in. So the real question now, the one that actually matters, isn't about the Fed. It's about where the money is going now.
To answer that, we have to start at the highest level, the flow of capital between the major asset classes.
Okay, so this lays out the shift pretty clearly. Stocks, if you're looking at SPY, are losing momentum. No surprise there. But look at commodities, DJP. That is your emerging leader. And then there's Bitcoin, which is completely broken down. This confirms it's a risk-off rotation, right out of the speculative stuff.
And the weekly performance numbers? Well, they back this up completely. You can see capital flowing into commodities while stocks and crypto are bleeding. The key takeaway here is that this is a very targeted rotation. It is not a sell everything market collapse.
All right, for those of you who use relative rotation graphs, this tells the whole story. You want to be in that top right leading quadrant. Look at SPY. It's in weakening and it's heading straight for lagging. Now contrast that with commodities, DJP. It's in improving and making a beeline for leading. And Bitcoin? Already deep in the lagging quadrant, dead in the water. The takeaway is simple. Commodities are where the emerging strength is, period.
Okay, so from that high-level view, let's drill down. What's happening inside U.S. equities? Where is the sector rotation?
This chart shows you exactly where the money is moving. Over the past week, it has been all about transports and healthcare. Those are the clear leaders. And where's that money coming from? It's flowing out of tech and real estate. So what you're seeing under the surface is this defensive yet also cyclical rotation. Let's be precise about the laggards. Real estate, XLRE, has deteriorated significantly. It was trying to improve, but it's rolled right back over towards lagging. And it's not alone. Industrials and financials are right there with it, clear underperformers. These are the sectors funding the move into the new leaders. And on the flip side, here are your new leaders. Healthcare, XLV, has some serious upward momentum. We're seeing multiple stocks within that sector break out. Transports, IYT, also showing a ton of strength, up nearly 3% last week alone. And what about the old leader, tech? Well, XLK is now weakening and has basically become a source of funds for this rotation.
Okay, so we've identified the rotation. How do we turn that into an actionable tactical plan? We have to anchor everything to key market structure.
Listen up, because the entire plan for the next couple of weeks hinges on one thing, the 20-day moving average on both the S&P 500 and the NASDAQ 100. Our base case is that this level holds. If it does, we can be cautiously long the leaders we just talked about. The bull case, a decisive bounce off that 20-day. That's our signal to add exposure. And the bear case, a decisive break below it. If that happens, we reduce exposure and start adding hedges. It is that simple.
So the bull thesis in a nutshell? This is just a healthy rotation, not a systemic breakdown. This thesis stays valid as long as that key 20-day moving average holds. You have new leadership confirming breadth, and you've got positive year-end seasonality as a tailwind. The risk? Simple. The new leaders, healthcare and transports, fail to follow through.
Now for the bear thesis. The argument here is that deteriorating market breadth is a big warning sign of a correction. The trigger is a clean break of that 20-day moving average, especially on increased volume. A break would validate those recession fears from the jobs data and probably cause former leaders, like tech, to accelerate to the downside. The main risk to this view is a sharp reversal higher that creates a nasty bear trap.
All right, a quick and important disclaimer. This content is for educational purposes only. It aggregates public sources to help you stay informed and improve your own decision-making. Always do your own research. This is not financial advice.
And hey, if this analysis is helping you out, please take a second to like and subscribe. It really does signal the algorithm and helps the channel reach more people. Your support is greatly appreciated.
Okay, now let's look at a few risk-defined option setups that reflect this exact market structure we've been talking about.
First up, a bearish idea targeting one of those laggards, the retail ETF, XRT. The thesis here is pretty straightforward.
It's based on that weak jobs data and some very interesting institutional options flow we're seeing that's positioning for a consumer slowdown.
The structure we're looking at is a long-dated put-debit spread. We're going way out to December 2025 using the 7770 strikes. Now, this setup actually mirrors a very large institutional trade, and it gives you a defined risk way to express that bearish view. Your max loss is capped at the premium you pay to put on the trade.
So the rationale is all about alignment. We're aligning with big money positioning against a consumer backdrop that looks pretty weak. And because it's a spread, our risk is defined from the start, which makes it a suitable starter position if you share that bearish view.
All right, the second setup is on the other side of this rotation. This is a bullish play on a clear leader we identified, the healthcare sector ETF, XLV.
For this one, the structure is a call debit spread, probably looking at 30 to 45 days until expiration. Again, it's a risk-defined way to get exposure to what's working right now to this emerging leader. And the invalidation point is crystal clear and technical, a decisive break below the sector's own 20-day moving average. If that level goes, the trade is wrong.
The rationale here is simple. We want exposure to the strongest area of the market. We're looking to capitalize on that relative strength, the new leadership, and all those component stocks that are breaking out. The spread defines our risk, and we can even look to add to the position if we get a confirmed breakout above recent levels.
And one final critical reminder. Options involve a significant amount of risk and are not suitable for all investors. Your capital is at risk and losses can exceed the premium you pay. This is not trading advice, it's just a market update. You have to trade your own plan, manage your downside, and verify all data for yourself.